If you've ever heard of Enron or Wirecard, you know corporate fraud can destroy companies, wipe out wealth, and ruin lives. But there's another scandal, equally massive, yet far less known outside financial circles. It's about a company once described as Africa's IKEA, a retail empire spanning 4 continents, a trophy holding in global investor portfolios. Its name was Steinhoff International. And its collapse is one of the largest corporate frauds in history. The rise of a retail giant, Steinhoff's story began as a small furniture retailer in South Africa. Through aggressive acquisitions and expansion, it became a multinational powerhouse with over 12,000 retail outlets, presence in more than 30 countries. Household brands like Pepker and European players like Poundland were under its umbrella. By 2016, the company posted billions in revenue and was widely respected on global markets. Investors viewed it as a long-term growth story. The first crack, accounting irregularities, surfaced. Everything changed in December 2017. Steinhoff shocked the world by announcing unexplained accounting irregularities. Its stock price plunged, wiping out billions from its market value almost overnight. The CEO at the time, Markus Hust, resigned with immediate effect, but the resignation was just the beginning of a deeper, more disturbing story, the forensic investigation. Steinhoff appointed auditing giant PwC to dig into its finances. What PwC uncovered was staggering. Between 2009 and 2017, Steinhoff had clandestinely entered into numerous fictitious or irregular transactions. These entities looked independent but were effectively controlled or influenced by insiders. These fake deals were designed to artificially inflate profits, misstate asset values, and hide underlying losses and weak performance. In total, irregular transactions exceeding €6.5 billion were identified, essentially creating fictitious income that never existed. How the scheme worked. Unlike blatant theft, this fraud was complex and highly engineered. Fake transactions were recorded with fabricated documentation. Some contracts were backdated. Shell entities and intercompany transfers masked the flow of money. Paper contributions were used to inflate the revenue of underperforming subsidiaries. In some cases, fake intercompany income was used to cover up losses, creating an illusion of strength. For years, auditors and investors were misled by what they were shown, not what was actually happening. The immediate fallout. Once the truth began to emerge, Steinhoff's share price collapsed, wiping out colossal market value. Investors from pension funds to individual shareholders were devastated. Creditors pulled back, and debt obligations skyrocketed. Some estimates suggest the scandal caused losses exceeding 250 billion rands to investors, a blow many thought would never fully recover. The scale of the damage was so immense that regulatory and civil lawsuits were filed. Executives and accountability. Investigations extended well beyond the initial disclosure. In Germany, former European finance chief Dirk Schreiber was convicted and sentenced to prison for accounting violations and credit fraud linked to the scheme, the first executive imprisoned over the scandal. Former CEO Markus Hust was also implicated as the key figure behind the fraudulent reporting. Although his legal situation was complex and ongoing, South African regulators continued probing violations related to misleading financial statements, insider trading, and market manipulation by individuals connected to the fraud. Casualties, investors, jobs, and pensions. This wasn't just a headline. Across Africa, Europe, and beyond, pension funds lost value, retirement annuities were hit, unit trusts and investment portfolios were decimated. One government pension fund alone lost billions, prompting ongoing litigation to recover assets, and families to wonder if they'd ever see their savings again. Repercussions and restructuring. Steinhoff barely survived. With debt above €10 billion and assets under intense pressure, it entered restructuring instead of outright bankruptcy. Some units like Pepco and Pepco were spun off or repurchase deals were enacted to shore up value. In 2023, the company even started a rebrand to Ibex and began compensating investors through settlement funds. But the shadow of its collapse still hangs over it, a giant's moral hazard. Steinhoff's scandal isn't just about numbers, it's about corporate governance failures, where executives, auditors, and regulators all missed warning signs, where lack of transparency wasn't just an oversight, it was a culture. And for millions of investors, employees, and retirees, the cost was real. Lessons from the Steinhoff collapse. Aggressive expansion isn't impressive if it's propped up by lies. Audit oversight matters. Weak controls invite deception. Investors can lose everything when corporate trust collapses. Steinhoff was once a retail citizen of the world. Now it's a cautionary tale. A reminder that even giants can crumble under the weight of deception.